Well, thank you so much, Sunny, for such a warm introduction. I am delighted to be here with all of you today. Thank you for having me. Okay, I think I'm all set up. I am a technologically challenged millennial, and yes, that is an oxymoron, so just bear with me and we'll get through this. But today I just wanted to briefly touch on 5 trends that I think you should be aware of and keeping watch of this spring and this summer. We know that it's a more turbulent time in the markets right now. There's a lot that's percolating through and a lot of information that you're having to sift through and decipher with your buyers. So these are just 5 topics that I think you should be keeping your eyes on. So without further ado, we're going to start on a bad note, but we're going to end on a positive note. So bear with me. But this should be really of no surprise, i.e. the potential for a recession, a national recession. We know that, of course, we have several headwinds right now in the national economy, inflation being one of the most predominant. It's cooling, but very slowly. And so that's creating the potential for the Federal Reserve to have to perhaps raise the federal funds rate yet again. And that puts a damper right on demand for goods and services, and also can cause some interest rate risk, right, with the banks. That's what we've been seeing with some systemic bank failures with Silicon Valley Bank, Signature Bank, First Republic, et cetera. So there's some risk embedded in that. Of course, we also have now the uncertainty over what's going to happen with the debt ceiling. We'll have some indication of that moving forward within the next couple of weeks. But right now, expect a little bit more volatility in the Treasury market. Of course, the yield on the 10-year T-note is highly correlated to movements in the 30-year fixed rate mortgage average, i.e. the 30-year fixed rate mortgage average tends to track the movement on the 10-year T-yield. So as demand for that 10-year T-note rises and falls based on news about whether we're going to see a resolution with the debt ceiling or whether it's going to continue to be an issue, again, expect that to trickle through into the mortgage market with rates fluctuating a little bit. So expect a little bit more volatility in the short run with that. And then we also actually have some factors that are helping us or have helped us kind of narrowly avoid a recession thus far. Of course, the still strong labor market has been an issue for the Federal Reserve, and that's one of the reasons why they've continued to raise their target federal funds rate. However, it's good for the average consumer, right? And that we've seen pretty strong wage increases. We'll go into that a little bit more later on. But consumers, the average worker has seen pretty strong wage growth, so that's helped them mitigate the effects of inflation, right? We also have consumers with still relatively robust balance sheets. We're starting to see consumers having to pull down a little bit more debt, credit card debt, et cetera. But of course, the gains in home equity that existing homeowners made through the pandemic, and of course, windfall fiscal stimulus, that's, was such a boon to the average household that they still have some excess savings from all of the economic impact payments during the pandemic. And then we also have pretty resilient still consumer spending. We're starting to see some signs that consumers are tapering their spending somewhat, but all in all, it's been pretty resilient over the past several months, even though we've had strong inflation. With that being said, though, let's talk about the labor market in Austin. And this is one of the reasons why that if we do see a national recession, Austin is actually going to be able to weather it much better than the overall economy. The reason being our very strong labor market. So our job growth continues to outpace that of Texas. You can see Austin is that blue line. So our job growth year over year in March was hovering around about 3.7%. So we're coming in, the gap between Austin and Texas is narrowing, but we're still seeing relatively strong job growth throughout the MSA. We are also seeing a pretty low, actually a historically low unemployment rate in Austin. Again, we're measuring below that of Texas. And so by all indications, our labor market is one of the strongest in the state, and that will allow us as an MSA to better weather a potential recession, in the sense that companies, their earnings growth has been strong, the potential for layoffs, if they do occur, probably won't be as considerable as it otherwise will be across the state and across the nation. So this is all very good news, right, for our regional economy.
Quick question.
Yes.
What percentage of unemployment would you like to see? 6 seems relatively high.
Right. So right now we're hovering around 3.5%. In terms of kind of a normative unemployment rate, we are right now probably at about full employment here in Austin. We added 64,000 jobs year over year with such a low unemployment rate. It's kind of indicating that there's probably not a whole lot more wiggle room. In terms of what we'd ideally like to see, not much, probably above about 5%. So it all depends, right? It's all relative. But yeah, once you start trickling above 5%, you get a little bit worried. In terms of wage growth, Austin has actually outpaced all 3 other major MSAs in Texas since 2007. We're in blue. We've outpaced Dallas, Houston, and San Antonio with respect to wage growth. So again, it's well positioning us to weather any sort of potential downturn. And it's also, right, symptomatic of a very strong labor market. Companies are willing to, the demand for workers are so strong that companies are willing to pay them more than companies in Dallas, Houston, San Antonio, et cetera. Moving forward, from 2020 to 2030, Austin, Travis County, and then the outlying areas are actually projected to see much stronger job growth than that of Texas. And the particular industries in which we're expected to attract the most new workers is leisure and hospitality, professional and business services, information, and financial activities. And this is very important to be aware of, because when we think about earnings potential for those 4 categories, of course, leisure and hospitality workers are going to be lower earning workers, but the following 3, professional and business services, information, and financial activities, those are the 3 most high-paying industries in the economy. So we're going to be adding, a lot of jobs where there's the potential, right, for those employees, to demand home ownership. So that's important to consider moving forward. Okay, now let's focus on our demographics. Population growth, following that job growth that we're expected to see through 2030, population growth in Texas is anticipated to, or population growth in Austin is anticipated to outpace that of Texas. So with respect to owner-occupied households, i.e. homeowners, by 2028, we'll have grown about 17%. And then by 2038, 15 years from now, we'll have 54% more homeowners now than we will, today. So we're outpacing Texas too in that regard. So Texas is anticipated to add about 31% more homeowners over the next 15 years. And then meanwhile, with respect to renters, i.e. potential home buyers, the Austin MSA is anticipated to add about 40% more renters over the next 15 years versus about 30% in Texas. And another important note from this chart is the growth for homeowners, i.e. owner-occupied households, is outpacing the anticipated growth for renters.
Can you back out a little bit? Are you using current metrics of home affordability? Where's your growth coming from?
So these numbers are from the Texas Demographic Center. So they're projecting population and household growth over the next.
Are they saying we're also anticipating current household ownership rates of X and Y, and that stays constant through this?
Sure. So they're probably, I don't know their exact methodology.
Right. So affordability in Travis County.
And then in terms of household income growth, of course, owner-occupied households, i.e. existing homeowners, earn more than renters. That's not new information, but just in terms of that exact percentage breakdown, over half of existing homeowners in the Austin MSA make at least $100,000, while about half of renters in the MSA make between $50,000 to $150,000. Or you could also slice it into half of existing renters make between about $35,000 and $100,000. So just that percentage breakdown and with respect to those potential buyers. Now moving into affordability, and of course this is a very important long-range trend for us to be considering, right? It's affecting our ability to turn those renters into potential home buyers. And we know that higher rates, the doubling of rates since March of last year, has imposed more constraints on our lower income buyers. That's already appeared in the home price data. So from March of 2022 to March of 2023, with respect to the percentage of homes sold that are affordable to each income cohort, we have seen the largest declines for the lowest income cohorts. So for example, for households earning $80,000 in March of this year, they could afford a maximum home price of about $250,000, rates, the average rate hovering about 6.3% in March versus near $300,000 in March of last year when rates were hovering more, closer to 4%. And then with respect to the percentage of homes sold in March of this year, the Austin MSA saw about 3% of homes sold that would be affordable to a household earning $80,000, whereas last year we saw about 4% of homes sold that would have been affordable to those households. So that decline in affordability, again, has been the strongest for our lower income buyers.
Is that total household income?
Yes,
Okay.
yeah. With respect to first-time buyers, so just considering even lower incomes, $50,000, $60,000, $70,000, again, we're seeing very similar trends in the sense that the percentage change in the proportion of homes sold in the Austin MSA from 2022 to 2023 has declined most significantly for those at the bottom end of the income distribution. Why this is important, of course, these are renters turning into potential buyers, and the more constraints we see for our lower income buyers, the more out of touch it's going to be for them to attain homeownership, and that could potentially play into sales activity, total dollar volume sales, et cetera. And then lastly, tying in the affordability constraints to long-term trends within the Austin MSA, considering housing supply, we know, of course, that we have chronically undersupplied housing for the lowest income cohort. So for example, for households earning less than about $50,000 in 2019, among existing homeowners, we saw that there was a lag in the supply of homes that would have been affordable to them. And of course, that's only worsened over the past 4 or 5 years. Now we have undersupply for existing homeowners earning between $50,000 and $100,000. So this is definitely a hot button issue. It's something that the City Council is certainly aware of and wants to work towards, we hope. But overall, it's something that we are very much focused on here at ABOR. We want to make sure that our city is affordable to all, right? That's one of our key missions. And of course, homeownership plays such a vital role in building household wealth that when you have these affordability constraints, such strong affordability constraints at the lowest end of the income spectrum, then you're just potentially diminishing the ability of those households to be able to build, to accrue that kind of wealth that we see through homeownership. So that was among existing homeowners. And then for renters, of course, the disparity widens among the lowest income renters. We see that wider gap in the imbalance between the supply of homes available for sale and the demand for those homes. So for example, in April of this year, we saw for households earning between $75,000 and $100,000, those renters demanded about 15% of the stock, but only 7% of sales, closed sales in April would have been affordable to them. So that's a pretty stark difference, right? Only about half, even less than half of homes sold in April this year would have been affordable to those renters earning between $75,000 and $100,000. So just something to consider moving forward, especially with respect to advocacy work and trying to, chart long-term goals with respect to where the city's going and what kind of developments we want to see. So with that being said, those are the top 5 trends that I think you should be keeping track of this spring and summer and moving forward. And I would love to answer any of your questions at this point. Thank you for having me.
Y'all have any questions for Claire? What a fun opportunity to have somebody right here that you can ask questions in front of your peers,
Call me out.
your close friends. No? Well, if you haven't, tune into the right before the huddle starts at 10:30 every day. It comes out at 10, right? Every Tuesday at 10 a.m. and you can subscribe to the YouTube channel. But their little morning drive market updates are so good. I loved that. And it was funny because I was in a focus group with the PR company that they use here at ABOR, and somebody, right before they started that, and one of the participants in our focus group literally said that exact thing. I wish there was a podcast that came out once a week that just gave me like 10 minutes of a market update, and like, boom, it happened like
Done.
in the next
Delivery.
day. So,
I have a question about interest rates.
Yes.
Do you think there's a pretty good chance we'll see really high interest rates this year, towards the end of the year, 7-8%?
Right, that is a great question. So right now, rates are hovering, the average rate is about 6.4%. In the near term, anticipate a little bit of volatility. The reason being, of course, the debt ceiling decision looming, depending on when and if a decision is reached. It's certainly causing a lot of volatility in the Treasury market. And the potential, if the debt ceiling is not resolved, then demand for treasuries is going to decline substantially, right? So that's going to push the yield on the 10-year T-note up, which would push mortgage rates up. Anyways, if the debt ceiling is resolved, a resolution is reached, then I would anticipate that mortgage rates should gradually decline actually over the year. We should be hovering probably in the high 5% range by the end of 2023, moving into 2024. The reason being that inflation is cooling. We've probably seen the last, if not very close to the last, batch of rate hikes by the Federal Reserve. So there should be some calming in the mortgage market, and the rate should actually decline. But again, that's predicated.
It doesn't improve, though. It could go as high as 8.
It could. I think if there's not a resolution with the debt ceiling, and of course, it's going to adversely affect the Treasury markets. There's already such a substantial gap, though, between the 10-year T yield and mortgage rates that I don't know that mortgage rates are going to be pushed that much higher, another 2 percentage points higher. But we'll probably see them closer to that 7% range. But it's the broad consensus is that we've already achieved peak rates. October, November of last year when we saw those 7% rates, that was kind of peak of the market. So again, we should see rates gradually start to decline a little bit. It'll be modest declines. But of course, housing is the most interest rate sensitive sector in the overall economy. So any decline is going to be good.
I was reading about the National Association of Home Builders being particularly bullish due to the supply issue side.
Right,
and so
right.
Are you kind of seeing that, having conversations around that? I know interest rates are a data point, a strong one, but if builders are also going forth with projects, it kind of gives me some confidence that there's still activity in the market. Things are kind of still going forward. And the likelihood of a huge rate hike is unlikely.
Sure. So the likelihood of another significant rate hike is very unlikely. And the reason being is that now we have this pressure, right, on our regional banks. And so it's broadly anticipated that the Fed, even though they probably won't start cutting rates necessarily this year, there's going to be a pause in activity on that front. With respect to home builder activity, actually starts are down, I want to say about 25% year over year in Austin. So there's been a little bit of pullback, right, from the builders, but that's with respect to starts. We've actually seen an uptick recently over the past several months in new permits, and of course permits are an early indicator of starts. So down the pipeline, you know, over the next several months, we should see an uptick in starts again. And that such a stark decline in starts year over year, of course, is an effect of the doubling of mortgage interest rates, essentially, you know, from March to April, May of last year.
You're just seeing other levers that are kind of, like you said, pipelines growing, and so that's a good sign.
Right, and it's also very important to think about what price points builders are focusing on. Of course, that affordable range of 200, 250,000.
85% of all sales.
Right.
That's a telling figure.
Right, yeah. Being able to supply new homes, though, at that price point is proving more difficult for builders given the regulatory environment, higher construction costs, availability of developable land, and the cost of land, et cetera. Yes.
What do you think the chances are that the debt ceiling issue will not be resolved?
Oh, that's a great question. And that's actually probably a better question for Emily or for Taylor, our Director of Governmental Affairs.
She asked about what do you think is the likelihood that the debt ceiling issue will not get resolved?
Yeah, I would be very surprised if it not. Yeah, it would. The potential, like the consequences of that, are just so severe that.
I think the bigger question maybe for you guys and the one that Claire can speak to is like the extent to which this continues and we put Band-Aids on the problem as opposed to resolving it from a political standpoint more long term, the longer you experience and your clients experience volatility in the mortgage market and in the greater economy. So like how long they push this impacts the potential for recession in the third and fourth quarter. How long they push this impacts the volatility in the mortgage market. All the unknown is always bad for markets of all sorts, housing included. So
Yeah.
we want resolution as an industry because we want continuity and we want firmness in the markets.
Right. Yeah, it's spooking investors, and also to some extent, long term, it can really spook employers as well, right? And then we can potentially see a contraction, that pullback in new hires and whatnot as firms are trying to weigh what's happening in the overall economy. But yes.
You may not have an answer for this, but I'm a little bit curious. Recently, well, I have on a few occasions recently seen a stat that says for every homeless person in the U.S. there's like 30 vacant houses. I don't know if that's accurate or not. I haven't corroborated this info. I'm wondering if you know if that is what we see here in our market, and like how can that be spun? Like what can be done about that?
Sure.
And
Well,
do we care to do anything about it, I guess, is also important.
right. Well, so that's going to be, I mean, that's pretty basic math. I have not seen that stat, and I don't know their methodology. But if you're thinking, okay, maybe there's a 5% vacancy rate, you know, owner and rental, 5% vacancy rate in the overall market, and there are 1 million housing units, then that's what, you know, 50,000 housing units that could potentially be occupied by a homeless person. Maybe. I would reckon that there are more homeless people than that in Austin. I don't know. I shouldn't probably try to do the math. So it could be true,
No, I know
but
a lot of moving parts to
2,500
this.
homeless people in Austin. There's roughly 2,500 people experiencing homelessness in Austin, properties.
I think the number's much higher than that. What I've read is when they did this count there, where it was a dark thing story, and also some.
right, yeah. Okay, so that, I shouldn't debate like the merits, yeah, the methodology on that particular stat.
Maybe I should clarify, I'm sorry, I think I'm trying to set you up for a trick, and that wasn't my intention. I guess, I think that the stat stat that I read was more relative not to vacant rentals that have, some percentage of vacancy every year, but more like second homes. And I don't know if we care to do anything about that, but I have concerns about our growing homeless
Sure,
population.
sure.
I don't really know what to do about it, and I'm just wondering if anybody has actual answers.
Yeah, no, that's certainly something to consider, and that's a great point about not necessarily vacant homes, but yeah, the vacation homes, second homes, whatnot. It's really going to be a matter of course, whether voters think that that's an important issue. So we'll potentially see that proposed by someone on city council, and then that could perhaps trickle through to voters. But
From an advocacy perspective, our focus has largely been on helping enable programs intended to place those experiencing homelessness in a way that meets the needs of the market as well. There's a big misunderstanding, especially in voucher programs, of like the obligations of property managers or the burdens and liabilities that an owner experiences, not specific to this population, but just in general. And they feel such urgency around putting people in homes, which is totally understandable, but they circumvent a traditional lease contract and understanding of the obligation between tenant and owner. And so we've worked really hard just to try to educate the firms that are working, especially with voucher programs, to understand those gaps, understand how we can mitigate risk. Like, for instance, there's a property repair pool that the city operates that says for an owner that participates in these voucher programs, should damage be done to the property, we're going to mitigate that for you and allow you to tap into the pool for repairs should you experience that. So finding ways to kind of fill those gaps so that we can place people, but do it in a way that is consistent with what contracts require and the industry requires, has been a lot of ABOR's focus. Certainly we share concerns about both the implications of literally the humane side of people living without homes, but also just the impact of the community at large, the optics of that in terms of how our community grows and caters to that. We've been engaged at a city level in all of those issues, but we've tried to really hone in on what expertise can we bring to the table, because we don't have the expertise to solve the problem alone, right? So we're weighing in where we can.
Thank you, that's helpful.
Sure.
yes.
Do you feel like the more Austin job growth is, tech oriented with the tech industry, the more we might be likely to see larger layoffs? And because it seems like the tech industry just kind of hires without looking down the path too much.
Sure, that's a great question. So let's talk about the tech environment in Austin. What's happening right now broadly across the nation in the tech industry is that the majority of layoffs have been concentrated among managers, they're normally called middle managers, who were hired in large swaths during COVID, now being laid off. Austin is relatively insulated from that in the sense that we are more concentrated in the R&D side, the research and development side of tech. We have a much higher proportion of engineers than we do business, people with business acumen, those middle managers. So in that sense, we're going to be able to better weather this tech layoff. That being said, information month over month was down 12% with respect to job growth, so indicating that we are seeing already some of those layoffs percolating through. And of course, it's not just concentrated among those managers, but that's been, the majority of it. Long term, of course, information in that one slide we saw that information is going to be one of the top industries with respect to anticipated job growth. It's the third in Travis County alone, adding 30% more jobs in that industry by 2030. I can't necessarily speak to the types of jobs within the industry that will be added, but certainly on a long-term basis, thinking about potential effects of volatility within the tech market on Austin will be important. But again, important to remember too that those are some of the highest earners in our MSA.
Do you think that Austin will see more of the manufacturing coming up on the outskirts of Austin being built? Because I know there's a lot around like Houston and everywhere, but do we
Sure. So it's so manufacturing around Houston has largely been because of its heavy oil and gas presence, and of course Dallas too has seen that, and then San Antonio, what with kind of Army, Air Force, all that. In Austin, we just historically haven't had that kind of presence in manufacturing, just because that hasn't been a concentration in job growth. You can see on this particular chart, job growth in manufacturing is lagging pretty much every industry with the exception of public administration. So expectations for growth, at least within the real estate sector, are probably going to be lower than, other sectors, if that makes sense.